Hi everyone, welcome to this review of the third quarter 2023. In this video, I will give you a short summary of what happened in the markets and in the portfolio during the period from the 1st of July until the 30th of September. If you have any questions or suggestions, please do let me know, either in the comments here on YouTube or in the comments on eToro. If you are new to the portfolio, here is a little overview. I created the portfolio roughly 3 years and 2 months ago in August 2020, and I'm very happy to say that by now there are close to 5,000 people copying and more than 400,000 people following. If you look at the investment strategy, it can broadly be categorized into value and growth at the right price. I like to keep things simple, so I only invest in stocks, no shorts, and no leverage. And the goal of that strategy is to outperform the European and American indices over a multi-year timeframe. By default, I compare portfolio performance to the S&P 500, which is broadly considered as the market. Now that is also what I'm doing on the next slide, which shows you the performance of the portfolio from day one until the 30th of September 2023. It also shows you the S&P 500. So the solid blue line is the Ingroq portfolio, and the dotted orange line is the S&P 500. So you can see very clearly that the performance of the portfolio, of the Ingroq portfolio, is vastly better than the S&P 500 in that time frame. So since day one, since the last 3 years and 2 months, the portfolio has delivered roughly 74.5% in performance, whereas the S&P 500 has delivered roughly 31% in performance. If you look at that from a compound annual growth rate point of view, that means roughly 19% annual growth rate for the Ingroq portfolio, compared with only roughly 9% on the S&P 500 per year. You can see also very easily in this portfolio when the outperformance started, and that is at the beginning of 2022, which is obviously last year. So last year, the performance of the portfolio was much stronger than the S&P 500, and I am very happy to see that also this year the portfolio has delivered respectable gains, which made sure that those gains from 2022 could also be defended. Let's zoom in a little more and have a look at 2023 so far. Again, the Ingroq portfolio is in solid blue, the index is in dotted orange, and here we are obviously looking at the first 9 months of the year. You can see that until the end of April, the portfolio and the index were roughly in line. There was general optimism in the market. It seemed like the path of interest rates was becoming clearer, and even the banking crisis in March seemed to be well under control. Then in May, the index really took off, mostly driven by optimism around artificial intelligence. That uptrend continued until the end of July, but then started to lose some steam in August. Instead, new concerns emerged about interest rates and that they will probably stay elevated for a longer time than people had previously anticipated. As you may remember, the portfolio took a hit, especially in May, mainly due to concerns about a global recession. Since then, the portfolio has recovered well in comparison to the market. In particular, it was able to avoid the downdraft in September. As a result, the portfolio's performance has again come very close to the performance of the index. By the end of September, the portfolio was up by 8.4% on the year, and the index was up by 11.7% on the year. Now, let's zoom in even more into the last quarter, the period from the 1st of July until the 30th of September. This is what you see here. So July, August, and September, you see also three different colors, green, yellow, and red. In July, quite obviously, you still had the last part of the AI rally, which was driving up the index especially, and also had a positive impact on the portfolio. Then in August, there was actually a lot of volatility, which is not really untypical for the market, simply because in summer there is lots of people on vacation, there is less volume on the market, and therefore some events or some movements on the market are just a bit more exacerbated than they would be at other times of the year. In September, that changed because seemingly everybody was back in the office and they started to price in the news which they had received over the last couple of weeks. And in this case, that meant that the index took a turn to the downside. Mainly that was because investors started to price in this scenario of higher for longer, meaning they are now expecting that interest rates will stay elevated for a longer time than they previously thought, which is generally not a very good environment for stocks. It is, of course, also very important to look at what companies are driving the success in the portfolio. And here you see the top three and the bottom three. On the top, you've got most notably Vistra and Shell. Those two companies alone were able to drive the portfolio performance very significantly in the last quarter. First of all, that's Vistra, which was able to make a contribution of 3.1% to the portfolio success. That is mainly a story of the company being able to deliver on the cash flows, which they had previously promised. And that means that they are also able to buy back shares to the degree which they previously announced, and also to continue paying their quarterly dividend. So investors started pricing that in even already in June, and that has driven up the stock a lot. And actually, I took the chance in the portfolio to sell a part of that position at good profits, plus 25% and plus 38%. Then the second best contributor to portfolio success was Shell, the oil and gas company, which drove up the portfolio by 1.4% during the last quarter. That is a result, of course, of higher oil prices and higher gas prices, which is definitely something that helps to produce more cash flows at Shell, which again, that company has announced they will use mostly for share buybacks and also to pay an increasing dividend every quarter. The bottom three performers in the portfolio were Hewlett Packard, Salzgitter, and Lufthansa, all three for slightly different reasons, but of course, overall related to a weakening economy in the world. So, Hewlett Packard, most of you will know this company. They are selling computers and are currently still experiencing quite weak demand for their products. So, as a result, they missed on their earnings and dragged the portfolio down by minus 0.5%. Second one on the bottom, Salzgitter, that's a German steel producer. They were also, of course, not really benefiting from the general environment of higher interest rates, because higher interest rates generally mean that there is less construction, which is impacting the demand for steel. So that company dragging down the portfolio by minus 0.7%. And on the third one, you've got Lufthansa, which is an airline that dragged down the portfolio by minus 1.2%, which is mainly a result of higher oil prices, which makes it more expensive to fly the planes. And at the same time, coming out of summer, there is less demand for flights. So, the big question, what is ahead? And I think before digging into that question, it's important to briefly look back at the last 9 months in 2023. You might remember that the mood was quite dark in the end of 2022, and most economists were expecting some kind of recession in the US and in Europe. So the good news is that that did not happen in that shape. Quite the opposite. The global economy, was still quite resilient, and so were also stock markets. The US stick out among this. They have a very strong economy, and their GDP is probably going to grow around 2% in 2023. In Europe, that looks a little bit different, but also not as bad as was previously expected. There are some countries which are experiencing a contraction in GDP, but those contractions are still manageable. Examples are Germany and Sweden, where the GDP is expected to shrink by about 0.5% in 2023. Not great, of course, but also not as terrible as was anticipated in the end of last year. That is not to say that there are no challenges. Of course, there are still some old challenges, if you want so. Inflation is still elevated, especially in Europe, so central banks still have some way to go in order to bring down inflation under the 2% goal. At the same time, economies, again, especially in Europe, do remain vulnerable to energy shocks, which is something which will become particularly relevant in the next couple of months when we are entering the cold part of the year. All of that is against the background of still rather high debt levels. That applies for consumers, for companies, and for governments, which is quite likely to create problems the longer we have an environment with higher interest rates. So, on top of that, we also have new challenges. I bundled three of them down here. That is, of course, the Israel Hamas war. That is also the dysfunction in the US Congress, which is really just an expression of the underlying political division in the country. And that is something which will definitely become relevant in the context of the US presidential elections, which are supposed to take place in about a year from now. So, all in all, if you look at all of this, it's really not hard to see challenges for the global economy. And that is something which, again, many economists and investors agree on broadly. The question is, of course, what do you do as an investor? And as you know, my strategy is built in a way that the portfolio should be resilient to many different scenarios. And I think that is still the case. I think whatever the scenario is over the next 12 months, the portfolio is well positioned to battle those challenges. That doesn't mean it will always go up, but it should perform reasonably well compared to the S&P 500. You might have also seen that currently the portfolio has a rather elevated cash balance. We are at around 20% at the moment. That is a result of taking some profits during summer, like I explained before with Vistra, for example. And I think that is, in fact, a good buffer if the environment becomes a bit more choppy, a bit more challenging. And it might furthermore enable also to take advantage of some buying opportunities in the market. All right. And at that note, I will leave it for today. That is it for the review of the third quarter 2023. Let me know what you think in the comments. Let me also know if you have any questions or suggestions, and then I will see you next time.